Everyone is asking the same question right now. Has the Indian market bottomed? Is it safe to buy the dip? Or are we about to fall even deeper? Here's the problem. Most of the people answering that question are guessing. They're looking at a red chart and calling it cheap. They're looking at a small bounce and calling it a recovery. But there's a way to actually check. There's a framework, not feelings, not vibes, actual data points that tells you whether this is a short, painful fall or the beginning of something much longer and much harder. And right now, the answer is uncomfortable. Let's start with the most important question. Is this a short-term problem or a long-term one? Because the answer to that single question determines everything. So let's go through the checklist. Left side, signals this is short-term and a recovery is coming. Right side, signals this is structural and the pain could last years. First point, was this fall triggered by a specific event? Indian markets fell sharply in March because of the war in Iran. Event-driven crashes like COVID in 2020 tend to be sharp and short. Second point, are domestic investors still buying? While making this video, we haven't seen the data from March. India's monthly SIP contribution was around 30,000 crore rupees in February 2026. So based on the latest data from February, retail India hasn't panicked and redeemed yet. Remember, March data would be important. Third point, is India's GDP growth story still intact? India is still one of the fastest growing large economies in the world. IMF projects India's GDP growth at 6.4% for 2026. The economy hasn't broken. But remember, Goldman Sachs and Moody's did cut their forecast for FY 26 to 27 because of the war. Now right side. First point, were markets expensive going into this fall? The Nifty 500 CAPE ratio, which is a valuation metric that smooths out 10 years of earnings, peaked at around 46 in late 2024. The long-term average is around 30. Even after the fall, we're sitting around 40, still well above the mean. Second, are foreign institutional investors still selling? FIIs have been consistent net sellers. FIIs pulled out over 1.2 lakh crore rupees from Indian equities in the March alone. They haven't stopped. Third, is the dollar getting stronger? Yes. Since February, it's getting stronger, and a strong dollar is the single biggest enemy of emerging markets. When the dollar gets strong, it means people want more dollar against other currency. Right now, the DXY, the dollar strength index, is going up, but the US bond yields are also going up. These three usually don't rise together, which indicates even bigger risk. Right now, investors are expecting sticky inflation or higher interest rates for even longer periods. And if investors can get more than 4% risk-free in US bonds, they would not take risk investing in emerging markets like ours. Fourth, are Indian corporate earnings still growing fast enough to justify valuations? No. Earnings estimates for Indian companies have been getting cut. Nifty 50 earnings growth estimates for the market had priced in high growth. That growth hasn't arrived. So the scoreboard right now, 3 points for short term, 4 for long term. That doesn't mean the market is definitely going to crash another 30%, but it does mean the conditions for a clean V-shaped recovery are not in place. The more likely scenario, based on what the data says today, is a grinding sideways market where time does the healing. India's been in this situation before. The Nifty peaked in January 2008 at around 6,300, then crashed nearly 60%. By late 2010, it was back near the highs, and then nothing. For 3 straight years, 2010 to 2013, it went nowhere. Investors who bought at the 2008 peak waited 6 years just to break even. But here's what made 2008 different from 2020. There were specific signals that told you the bottom was real. Most people missed them. Here's what they were. A real market bottom doesn't announce itself. It never does, but it leaves fingerprint. First fingerprint, selling exhaustion. This is when bad news stops making the market go lower. When a terrible headline hits and the market barely reacts, that's exhaustion. That's the sign market no longer cares about it. Second fingerprint, the VIX spikes and then collapses. The VIX is the fear index. It measures how panicked investors are. At real bottoms, the VIX hits extreme highs. India's VIX spiked above 85 during the COVID crash bottom in March 2020. Then it collapses fast. The spike happens when the last sellers sell. The collapse tells you they're done. Third fingerprint, CAPE approaches or crosses below the long-term mean. Remember, the Nifty 500 mean is around 28 to 29. Real buying opportunities in India have historically appeared below that level. Nifty 500 CAPE dropped to near 15 to 17 during the 2008 crisis bottom. Right now, we're at 39. We'd need a bigger fall or years of earnings growth with no price movement before valuations become genuinely attractive. Fourth fingerprint, FII flows stabilize or turn positive. Not one good week, a consistent change in direction. When the institutions that have been selling start buying again, that's fresh capital entering the market. It moves prices. So if we haven't bottomed, and this might drag on, what would actually turn things around? Because this market isn't broken forever. India's growth story is real. But a story, no matter how good, can't fight a bad macro environment. And right now, there are very specific things that need to change before the bull market resumes. Here's the list. 1. The US dollar weakens. When the dollar falls, emerging market currencies strengthen. Money flows out of American safe havens and looks for growth. India, with its size and growth rate, is always near the top of that list. Historically, a 5% decline in the DXY has been associated with significant FII inflows into Indian equities. Watch the DXY. When it starts a clear downward trend, not a single bad week, a trend. 2. U.S. interest rates fall meaningfully. Right now, you can park money in U.S. Treasuries and earn a safe, dollar-denominated return. U.S. 10-year Treasury yield remained above 4% through early 2025. Why would a fund manager take the risk of Indian equities, currency volatility, and EM exposure when America gives you 4% risk-free? The answer is, they won't. Not until that number drops enough to make the trade-off worth it. One cut won't do it. A clear cutting cycle will. When the Fed signals a sustained easing path, watch FII flows into India change almost immediately. 3. Indian earnings reaccelerate. The market doesn't just need India to grow, it needs the corporate earnings to actually show up in the numbers. Right now, earnings estimates are being cut. For the bull case to resume, you need 2 to 3 consecutive quarters where earnings beat expectations. Not just GDP numbers, actual company profits grow. When that starts happening, PE ratios compress naturally. The market becomes cheaper without prices falling. 4. Crude oil price. This one is specific to this moment and very important. The Iran war sent oil above $100. High crude means a wider deficit, a weaker rupee, higher inflation, and squeezed corporate margins. It affects everything. When crude drops, it doesn't just help India's economy, it takes pressure off the dollar, gives the Fed room to cut, and lifts corporate margins all at once. So now you know what to look for. Keep your eyes open, and I'll see you on the next one.